Welcome back. It's been a while since I've done a portfolio review, so we'll try to catch up on the last 3 months of March, April, and May in this video. Over this time, we went through a decent pullback that started in March and continued on throughout April before reaching a bottom and then rebounding. The market is now back to all-time highs again in both the S&P 500 and the Nasdaq. The portfolio itself was negative in capital return at one point during this time, which means it was digging into my profits. But now it's at all-time highs as well in terms of the total return. So we'll go over all the changes in the past 3 months, and we'll also have some bonus spreadsheet content that I haven't shared yet in past videos as to how I use it on a daily basis sprinkled throughout. I'll also have a special announcement at the end of the video that quite a few of you have been asking about, and it's now ready for a trial run. Get ready for a lot of information here, and let's get started. Starting with the Transactions tab, we'll filter for the non-registered account, and then for the months we'll select March, April, and May. For the last 3 months, there has been $100 deposited into the account, and also 71 cents from stock lending that was paid out. In terms of dividends, there was a total of $2,018.07 that has been collected. Then for changes, I ended up selling GWO and actualized a $385.69 profit on the sale. I then redistributed the investment and profits mainly into technology ETFs to grow those positions some more, and then bought some BCE to bring my average down a bit. If I highlight the lot values of how those investments have been performing, I can see that they are up in the green overall, with Google being the top performer. For the other purchases I've made, most of it has been in the sector or index-based ETFs such as Bank, ENCL, USCL, and HYLD. I also added a little bit to Duro Clean Technologies as it's pulled back a bit recently. And as a new introduction, I finally included a position in crypto with BTCY, but it's only a very small position of $100. In general, if I highlight the performance of all the purchases I made over the last 3 months, I'm positive overall by $15.18. Now on the dashboard, to start, I'll go over this performance indicator that I haven't talked about previously yet. This is something I put together on my own, but there are 3 main ratings for the portfolio: high performance, moderate performance, and poor performance. For the portfolio to achieve a high performance rating, the portfolio needs to have a value which is above the total invested value. This is shown in the portfolio value history chart here. What this means is that overall the portfolio has seen positive gains from all the money you currently have invested in the market, and that you haven't lost money on what you've put in so far. This is a good sign because it shows that your investment decisions are paying off currently. A step below this is the moderate performance rating, which indicates that your portfolio value is below your total invested value, and that you've lost some money in what you have currently invested in the market. While this sounds bad, this isn't the end of the world and that you should start to panic, because while your portfolio value is below the total invested value, your portfolio overall is still in the green and it is still profitable, but the profits are just being eaten into a little bit. To put this into context, it can happen when there are strong pullbacks in the market, and in the case of my own portfolio, you can see in the portfolio value history chart that it's happened a couple times already, and even most recently as April in fact. So this rating isn't a panic rating, but it's an indication that you may want to assess and look at what's actually going on in the portfolio or in the market currently before making any rash decisions. Now for this last rating, which is poor performance, this is where you're going to want to pay real close attention to your portfolio and figure out if there's something wrong or if it's just the market crashing drastically. This rating is when your portfolio value has slipped below your total deposited value, and it means that the portfolio is no longer profitable and that you are losing money overall. This was actually the case for the first 5 or 6 months when I started the portfolio back in 2022. It was a year when the Federal Reserve was raising interest rates rapidly, companies were doing mass layoffs, the overall market was crashing on bad earnings, and global conflicts were happening. You can see this clearly in the chart here, where my total return percentage dropped as low as -10% before the market found a bottom in October of 2022, and then started to recover. So while yes, this rating is bad because you're losing money, but if the cause is market related, then maybe there isn't much you can do. But if it's an investment decision related reason, then there might be some difficult decision making to be done to try and correct this. Hopefully this was insightful, and maybe this is something you can look into for your own portfolios to see if it's a high, moderate, or poor performing one. Now moving on to comparing the portfolio values from the start of March until today, the portfolio has gained in overall value by $2,153.05. All of that can be attributed to the lifetime dividends and the sale of GWO, because if we look at the total P&L in the summary section at the top and subtract the difference, we actually lost $279.01 from the capital return. Whereas if we do the same for lifetime dividends, we can see a gain of $2,018.07. So from the last 3 months, the consistent nature of dividends has actually outpaced the capital appreciation in the portfolio. This is an interesting point in my opinion. It brings up the question as at what point does the dividends being paid out each month outpace the growth in capital appreciation? Because regardless of the market conditions, these ETFs are designed to continue to consistently pay out dividends each and every month. That's just some food for thought and something that I've been thinking to myself as well lately. I'll continue to monitor this for myself, but if you're currently living this, then let me know your thoughts in the comment section below. Now looking at the returns by sector, we can see that the total return for the technology sector has stayed flat and lost about $50. But if we were to look a bit closer, we can see that the capital return actually lost about $826 over the past 3 months. So the total return performance maintained over this period of time has actually been attributed to all the dividends that have been received. With communication services, we can see that the sector has further declined and hopefully the worst is already factored in, and that we'll start to see a little bit of recovery once the interest rates start to loosen. The utilities and energy sectors have finally recovered in the portfolio and are starting to show profits, which is great because they've been down for quite some time now. Now moving on to the summary section at the top, the day P&L is just the price fluctuations from a day-to-day basis, so it's not something that I pay too much attention to. The total P&L is the same as the capital return for the portfolio, which I mentioned earlier about the portfolio value that has decreased by about $280. This was also mentioned earlier on, where we have an increase to the total return by about $2,100. As for the dividend yield, it has remained above my goal of 10%. Then lastly, the annual dividends. While the gain doesn't appear like much when comparing it side by side like this, in reality it is much more significant and will be apparent in a later chart in the portfolio tab. Moving on to the charts now, if we look at the last 3 months, we can see that there was a short period where the portfolio value fell below the total invested amount once again, and this was due to a deep pullback we had in the month of April. Since then it has rebounded, and from the chart we can see it's now at all-time highs shown here, and also in the chart below comparing the portfolio value to the index return. When looking at the bar chart for comparison since the portfolio's inception, keep in mind, as I mentioned in previous videos, this comparison isn't something I put a lot of emphasis on, because what this chart is telling us is if I had made a single deposit in the S&P 500 or TSX indexes on the portfolio's inception date, then what is being displayed is the expected return for that one-time purchase. But as investors, we continue to add to the portfolio over time, and thereby increasing our cost basis and changing the total return percentages. So what's most important here is to look at this chart a bit more objectively and be more concerned with the portfolio's capital and total return itself, which in this case, since the portfolio's inception, which was 22 months ago, we have a 5.11% increase in capital return and an 18.98% increase in total return. If we divide these by 2, then that would mean a 2.56% rate of capital return and 9.49% rate of total return per year since the portfolio's inception so far. Keep in mind that the capital return here may seem low, but that's because I've actualized quite a few gains from selling out of some holdings, which would then remove it from this value, but would still be factored into the total return value. In terms of the projected monthly dividends, it looks like in July we should be surpassing the $800 mark in dividends for the first time, and the lowest amount per month looks to be about $550. Lastly is the projected portfolio value in 10 years, which we are currently in 2024. If we continue at the projected pace, then we should be able to hit these targets, but time will tell if we meet them. Now inside the portfolio tab with all the holdings, I don't think I've actually gone through this table yet in previous videos. So let's quickly summarize it so that we're all on the same page going forward. The first part is fairly straightforward and is just the stock name, stock ticker, sector, and industry. Then the next column over is how much is invested into each holding, with the total invested amount located at the bottom. And this is the number that's being used in the performance indicator on the dashboard I talked about earlier on in the video. After that is the average price for each of the holdings, how many shares I have, the current stock price, the day P&L, and the total P&L. Then below this is the running total of the cash that is currently available in the account needing to be invested. Now within this tab, the day P&L and the total P&L are what I'm mostly looking at on a daily basis if I'm just taking a quick glance at the spreadsheet. The day P&L tells me if we're positive or negative for today, and then the total P&L tells me if the entire portfolio is green or red overall in terms of capital appreciation, which is why the column is highlighted with a solid background emphasizing its greater importance. Moving over to this next section is everything related to the dividend information. First, we have the last dividend distribution that was paid, then the annualized amount of dividends we can expect, how frequent the dividends are paid, the current dividend yield, the 4-year average dividend yield, and then finally the lifetime dividend amounts we've received since holding the stock. Most of this is straightforward. The only thing to note here is the coloring within the dividend yield column, where it changes the text color to green or red based on whether it is currently higher or lower than the 4-year average yield in the column next to it. In comparing these two, if the current dividend yield is green, it means it is currently higher than the 4-year average yield, so if you were to invest now, you would be locking in a higher yield than the 4-year average. And vice versa, if the current dividend yield is red, it means it is currently lower than the 4-year average yield, so you might want to wait for the stock to drop a bit before investing more into the position. Then the summaries beneath this section are just the totals for the values above. The annual dividends total adds up all the values above and gives us the expected total we will be paid on a yearly basis from all of our holdings. This is another important number that I look forward to growing larger every time I reinvest dividends or put money into the account. Then next to it is the average dividend yield of the portfolio. So this is not a sum of the values above it, but a weighted average of all the values based on each of the holdings percentages within the portfolio. By using the weighted average, it reflects more accurately the true value, because a higher or lower yielding stock that only makes up 1% of the portfolio doesn't skew the average as drastically than if it were just an average of all the yields. You can see the difference clearly if I were to highlight all the dividend yields in the column and then change the bottom calculation from sum to average. You'll see that the average that is shown here is much lower than the weighted average number being calculated above, and this is likely due to my ATD holding, which has a dividend yield of 0.88% and makes up only 2.46% of the portfolio. Moving on, we have the lifetime dividend total, and this is just a sum of all the dividends collected from all my current holdings above, but also all the dividends I collected in the past from holdings I no longer own. Just 2 more sections left here, and this next one is sort of the performance section of the holdings. Here we have the 2-week chart of each holding, and then the lines are either green or red depending on its performance if the current stock price is higher or lower than the stock price 2 weeks ago. This next column is an important one when it comes to an individual stock or ETF's performance, and it lets me know the true return of each holding because it includes both the total P&L value and the lifetime dividend value together in its calculation. A prime example of this is YTSL, where if you just look at the total P&L or capital return, I'm currently down negative $2,335.64 or negative 26.21% on the position, but if you include the lifetime dividends that have been paid out, then I'm actually down only $898.24 or 10.08% overall. And that's the benefit of this particular style of ETF because it can act as a hedge on riskier plays, such as this one on Tesla, where it can be volatile and experience big swings in its price, just like it's currently doing now. So this is why if you're a dividend investor, looking at the total returns of a particular holding is very important, and it's not something you can see just by looking at the stock chart. It's something that can only be determined by specifically tracking it through a dividend tracking tool or a spreadsheet like this one. If this specific spreadsheet is something you might find useful, stick around towards the end of the video for a special announcement. Okay, then at the bottom here is the grand total and the most important number I look at when judging the overall portfolio's performance. This number is the sum of the total P&L, lifetime dividends, and any profits or losses from previous transactions all put together in one value. It's also what I use in the bar chart in the dashboard and the summary section at the top, so this is a number I always look at and pay attention to. Then the last column here is pretty self-explanatory, but it's the percentage weighting of each holding within the portfolio. You can see that most of the holdings are fairly close in weighting, with YTSL being the largest holding currently at 11.31%, which isn't most ideal, but I do have a strong conviction in Tesla, so I may have gotten a bit carried away. Seeing it like this though has helped put things into perspective and has reminded me to shift focus and to adjust the allocations more appropriately going forward. And what better way to do this than to talk about this last section of this table, where I've built in a queue for future purchases, and is also a way to project how you allocate or reinvest funds when trying to rebalance the holdings. I haven't seen such a feature in any other spreadsheets out there, and it's something I use quite frequently to plan ahead what my purchases will be when the next paycheck or dividend payments come in. Out of all the features I've built into the spreadsheet and I've shown you so far in these videos, this is the most useful part and the one I'm most excited to share. So as you can see now, it is currently showing $700 in the total Q section at the bottom, and this is just the sum of all the numbers in the column above. Now to show you how powerful this next simple action is, I'll highlight the key areas you want to pay attention to when I do this next step. Now following the mouse, all I'm going to do is select this checkbox to activate all the calculations in the highlighted areas to update the values based on the $300 I have queued up for USCL. Now let me uncheck and check the box again a few more times so you can understand a bit more clearly what is happening behind the scenes. Now I think you can put together what is happening here, which is that all these values are being updated as if I had invested another $300 into USCL at the current price. It also tells me here how many shares I'll be able to purchase based on the queued amount, and this has been really helpful when placing orders because I know exactly the number of shares to enter into the broker or platform and don't have to guess anymore. To me, this feature has been immensely helpful when it comes to portfolio allocation and planning, and showing the exact impact of an investment to an entire portfolio without actually having to put real money into the market. It's also fun to use too, and some of the main things I'm looking at when I'm using this is how the annual dividends increases, how it impacts my average price of the holding, and most important of course in a dividend focused portfolio is how the monthly dividend totals increase if I were to follow through with the purchase. So as you can probably see and tell, this is my favorite part of the spreadsheet, and it's also the one feature I use the most. Now we should move on to summarizing the actual holdings in the portfolio before we get too sidetracked. Starting with the Duro, there was a small decrease in the price which I bought into and added to my position a little bit. They released their Q3 earnings last month and they reported an increase of 78% to their revenue compared to the same quarter in the previous year. Apple has moved back into the green finally, and this is despite a 4% decrease in revenue from the previous year's quarter. There have been struggles with Apple so far this year, with antitrust lawsuits and international market challenges in China. Despite this, new potential innovations in how Apple will approach AI have been surfacing, and it's been helping the stock surge back up to approach all-time highs again. Microsoft stock has been teetering around my entry price and basically hasn't moved in price over the last 3 months. They announced beats in both their EPS and revenue for Q3, which helped it recover from a small slump in April. After reaching all-time highs in early May, Amazon has pulled back recently and is back to where it was trading back in March. There doesn't seem to be any headwinds for Amazon, and it might be a good opportunity to pick up some more shares here. Google was probably the biggest gainer in the past 3 months and has been on a run since it found a bottom in March when I last bought some more shares. It's been making new all-time highs on the way up, and this has been fueled by strong earnings, a surprise announcement as a new dividend payer, and continued work to implement AI into all of its products. Now for the opposite end of the spectrum, to no surprise, Tesla was the biggest loser in the past 3 months. It was already bad in the last video where I was still up overall because of the dividend, but the losses have now doubled and was actually tripled at one point. I still have conviction in Tesla and have been averaging down a bit as it's dropped, but I'm already quite overweight on it as it's the largest position in the portfolio at over 11%. Thankfully, even with a really bad earnings report, it finally found a bottom and surged up about 36% in about a week. Of course, there's no shortage of news around the company and Elon Musk, but some of the main tidbits are how Tesla laid off more than 10% of its workforce, they are ramping up the development of its entry-level EV, how there will be a reveal of its robotaxi project later this year in August, and then lately as if Elon Musk will get his massive pay package from the company. As mentioned earlier, with the dividends included, I'm currently down about 10.08%, but still continue to collect a 20% plus dividend yield every month. If Tesla can recover back up to the highs from last year at around $32 a share, then it would look something like this, which would be a pretty nice return. Moving on to ATD, after I made all-time highs in late February, it's been going through one of the stronger pullbacks the stock has experienced since I've owned it. And I was thinking of buying more on this pullback, but there are other positions I want to grow first. It's since started a bit of recovery now, and is slowly trending upwards again. Brookfield Asset Management from an investment standpoint is one of the smallest positions I have in the portfolio, so it isn't one I pay too much attention to. There are more interesting positions I like to add and build out, and since this one has run up 20% in total return already, there hasn't been a good opportunity to add more to it. For bank, this ETF just keeps dancing around my entry price, and just when I think it's breaking out, some bad news is announced and it drops back down. So as you saw in the transactions tab, I've been taking the opportunity to add more when it goes below my average price. It's paying a high dividend yield of 16.57% currently, so I suppose this isn't too bad of a scenario to be in. All the Canadian banks just posted earnings this past week, and there were some great winners but also some great losers. If there's one sector to not be in right now, it's the telecommunications sector in Canada. Since the beginning of the year, it's just continual bad news and a downhill stock price. There might be a slow recovery right now, but I'm hoping it's sooner rather than later, and until then I'll just continue to collect the dividends. Next to Google, Brookfield Renewables has seen an absolutely amazing 44% bounce from its bottom in the middle of April before they announced a partnership with Microsoft to expand its renewable energy capacity and provide renewable power to support its cloud services and infrastructure. It's great to see this finally back in the green after being one of the bigger losers in the portfolio for a long time now. This is a brand new position that I started just a few days ago, and I figured I would dabble and force myself to slowly learn more about crypto this way. Similar to Brookfield Renewables, CPX has also been in the red for a long time now, and might finally be on its way back up as well. Enbridge was finally slightly above my average price for break even before dropping back down to where it is now. I have to say I was tempted to sell it and move the investment to somewhere else, but with their acquisitions completed and a pending interest rate cut, it doesn't make much sense to not see this through after holding it for this long. Because of the dividends received, I'm actually up 6.21% currently, so if I were to sell it now with a slight capital loss, I still have made some money on it. This is similar to Enbridge, but this ETF holds the entire energy sector overall, and if I were to sell off Enbridge, I would likely add most of it into this position. It has a high dividend yield of 16.82%, and having only started this position in late December last year, I already have a total return of 14.5% so far this year. I haven't hit my target allocation for this yet, so I'll likely keep adding when it drops a bit. GoEasy is the first stock I purchased in the portfolio strictly for the intention of growth, and has definitely been a wild ride. At one point after I made my first purchases, this went up to $140 and then dropped all the way down to $90, where I averaged down and bought a few more shares. And now it's recovered back up to $190 after it posted some very strong first quarter earnings. From a capital appreciation standpoint, this is the number one holding currently, and in due time, maybe we can reach the all-time highs of the stock at around $220. The technology sector has continued to do really well, and this ETF just made new all-time highs literally this past week, but it's now pulled back on fears on interest rates being kept higher for longer in the US. Since the beginning of the year, this is still up 12% overall and pays a consistent 9 to 10% dividend every month. Overall, this has been one of my best and consistent positions in the portfolio and has returned 29.19% at the time of recording this video. As one of the core positions, HYLD has just announced last week that they'll be raising their dividend yet again to 14.3 cents. This is the fourth time they've raised it this year and is now at the highest it's ever paid. I finally passed the $1,000 mark in annual dividends with that raise, and my next target will be $1,200, which would mean I get paid $100 a month. Just like HTAE, it was at 52-week highs just this past week, but has pulled back a bit with the market. This ETF is my second highest payer of dividends in the portfolio, and in terms of total return, I'm up 24.98%. I've paused a bit since buying more in December before the changes to the holdings, but seeing its performance since the start of this year as shown in my other videos, I'm comfortable continuing to add to this and building it out to a larger position. It currently makes up 9.08% of the portfolio, and I don't mind growing it to upwards of 15 to 20% at the very least. Royal Bank has just had their earnings released this past week, and the reaction has been surprising to say the least. Since the October lows of last year, the stock has jumped up 37%, and with this recent surge of 5.69%, it's now made new all-time highs and has joined the $1,000 club in the portfolio for total P&L. With its earnings, it also announced an increase to the dividend by 2.9% to now $1.42. As the other telecommunications holding in the portfolio, TELUS followed the same trend as Bell in moving back down in its stock price. There's not much to like here except that with the earnings report, TELUS has also raised its dividend again by 3.46% as part of its biannual dividend raises. With the recent news about money laundering, TD stock dropped over 8% and made a new 52-week low. Its recent earnings also didn't do much for the stock, so we'll have to wait and see where it goes from here. Finally, the last stock in the portfolio, USCL has been performing very well since I purchased it before the start of 2024. If you watched a previous video where I compared it to the S&P 500 index, with distributions included, it has actually outperformed the index year to date. If you were to include dividend reinvestments, it has outperformed by even more. Like HYLD, it has pulled back in the past couple of days, so it's much higher, but in terms of total return, I'm up 6.39% currently. This is also another core position I'm looking to grow to 15 to 20% of the portfolio as well, and also have it join the $1,000 club and annual dividends very soon. The first chart we have here is the sector distribution chart, and there's not much change here aside from the inclusion of a new slice for crypto. I've been thinking about this one for a while now, about how this chart doesn't serve much purpose or provide any insightful information that can be drawn from it, but I think I have a solution finally looking at it right now. It currently is divided up by the number of stocks I have within each sector, but with this addition of a new crypto slice, it's a bit skewed and misleading due to the size of the slice relative to the actual investment within the portfolio. I think a better approach and one that is more informative is if they were updated to represent the invested value of each sector instead. That way you can tell if one sector dominates the portfolio's allocation and can then adjust if needed. Here is an updated chart with those changes made, and I think this is much more insightful, where it's clear that the technology sector is the dominant one in the portfolio and makes up 30.5% of the portfolio value. Financial services is the next largest, followed closely by ETFs. Personally, relative to the rest of the chart, I think the communication services sector is far too large based on my ideal allocations. Ideally, I would like the portfolio to be focused primarily on the US with the S&P 500 index, and then have a technology focus acting as a growth portion. Unfortunately, when I started investing back in the middle of 2022, I was just starting to learn, and as the market went down, I kept dollar cost averaging further into some of these companies. Most of them had worked out and I made some gains, but there's still some lingering ones that I've yet to recover, such as the communication services sector. So while I wait for that recovery, I've been working to fix the allocations, and I've been actively growing my ETF sector position, which contains USCL and HYLD, towards my ideal allocation of possibly 40%. Meaning that there's still a lot of work to be done, but we'll get there eventually. The next chart for portfolio allocation just visually shows every holding and how they're weighted relative to each other. Overall, most of the weightings are fairly close, with just a few that are slightly higher in YTSL, HYLD, and USCL. This chart is a duplicate of the one from the dashboard, but to add some fun facts, we can see I received my first dividends in August 2022, and it was a total of $13.42. If we take the dividend from the most recent month of May and compare it to the previous year's May, then that would be a 2.78 times increase year over year, or a 278.7% increase year over year. I don't expect this rate of growth to carry on, but we'll see when next year comes around. Continuing now to the individual stock price return performance, over the past 3 months we've seen some stocks soar wildly, partly due to earnings and partly due to other news. Keep in mind that this is just based on the stock price return and not total return, which would include all the dividends paid out as well. The most notable increase would be YGOG or Google, which is at 16.5% in price return, but has now gone up to 44.86% in price return. That's a whopping 28.36% increase, which makes me wish I had bought more of it back then. Then BEPC or Brookfield Renewables, which is at a negative 16.44% in price return, but has now gone up to positive 8.54% in price return. That's a 24.98% change from being negative and in the red to now being profitable and in the green. GSY or Go Easy also had a great earnings quarter and went from 52.21% to now 63.75%, which is an increase of 11.54%. Then the last one we'll talk about is Royal Bank, which also had a great earnings release and went from 7.43% to 21.3%, which is an increase of 13.87%. Of course, on the flip side, there were some big losers as well, with YAMZ, YTSL, ATD, BAM, TELUS, and TD, who are all down 5% or more. And on that, if we now take a look at the dividend yield and 4-year average dividend yield chart to look for opportunities, we can see that all of them, aside from Amazon, are at some favorable discounts compared to their historical 4-year average. I went over in detail in the last portfolio review video on how to read this chart, but essentially green means the current yield is higher than the 4-year average, and red means the current yield is below the 4-year average. So if you were to invest in any of those in the green, you would be locking in a higher yield and get a relative discount. It's important to note that this shouldn't be your sole reason to invest, and that this is just an indicator to help assist in the decision-making process. And it's also important to mention that some of these funds have been around less than a year, so I've arbitrarily set some of them based on their initial dividend yield at inception and will not be as reliable or accurate. Of the stocks that actually have more than 4 years of history, you can say that BCE, BEPC, CPX, EMB, TELUS, and TD are trading at discounts currently. But in the case of the telecommunications sector, there are still some major headwinds ahead. So even though you would be getting in at a discount if you were to invest now, fundamentally there may be issues as to why it's at a discount. So this is why you'll still need to make sure to do your own research. Moving on, we have the current price and the 52-week range chart. Again, this is just an indicator as to whether or not the stock is near its 52-week high or low to get an idea of premium and discount. As mentioned before, some of these are less than a year old, so the 52-week range may not be as accurate. But for the ones that have been around for over a year, the same suspects from before in BCE, TELUS, and TD seem to be nearest to their 52-week lows. As for 52-week highs, it seems to be only RY at the moment, but some of these like GSY has also hit 52-week highs recently and have pulled back slightly. Next, we have the capital return and dividend return chart, which just breaks down the performance of our returns from a capital and dividend perspective. The one that stands out most is clearly YTSL with its big capital loss, but it's also provided the highest amount so far in dividend payments in the portfolio. The high dividend yield has definitely made it easier to handle such a big unrealized capital loss, but we should eventually recover and break even on the position in due time. Amazon, Google, Go Easy, HTAE, HYLD, and Royal Bank are the top performing stocks in the portfolio, with all of them over the $1,000 mark in total return. Another thing to highlight would be that HYLD has passed the $1,000 mark in dividend return, joining YTSL as a top contributor from a dividend standpoint. From a growth perspective, GSY is the winner from a capital return standpoint. Coming into the last few charts, this is the projected timetable to reach 100K. I originally planned to have this completed in 4 years, and based on the contributions so far, we're ahead of schedule and should be projected to hit it by the end of this year. Since the last video, the goal was $8,000 in annual dividends, but since then we've passed it and will now be working towards the $10,000 goal. You'll see a sharp drop once we hit the $8,000 mark, and that's because of YTSL cutting its dividends as I mentioned before. We've recovered most of it through reinvestments in the past 3 months and should pass it again in the coming month. Then the target portfolio investment charts are to see how much I've currently invested in the market and how it's grown over time. Finally, we just have a duplicate chart of the one already in the dashboard, but it's repeated here again but a bit larger so we can see it more clearly. To add a bit of context here, if we look at where we are now for the total return line, we've been kind of stuck within a range for a while now. But we can see that we had just broke out of it and made new all-time highs earlier in the week, but have come back slightly off of it now. And finally, in some of the past videos, there have been requests for access to the personal spreadsheet I've built and have been using for the past 2 years now. In the past few months, I put a lot of effort into making the entire spreadsheet as user-friendly as possible and as easily to set up for beginners. So here I'm glad to finally announce and launch the ultimate Dividend Investment Tracker Spreadsheet to the public. This will come in the form of a Patreon subscription, which will also come with access to a Discord community where we can share ideas and where I can engage in conversations more directly with everyone. So who is this spreadsheet product for? These spreadsheets have been built primarily for dividend investors first and foremost, but it can also work just as well for those who invest primarily in growth too, and who may someday eventually transition into dividend stocks for retirement. The greatest thing that attracted me to dividend investing is because of the recurring nature and predictability of it, and how I'm able to keep track of progress in a spreadsheet format to work towards my goals. These spreadsheets have been integral to me as a dividend investor, and I want to share the value they bring with those who are also interested in tracking their dividend portfolios in the same way. By monitoring the performance of the holdings, evaluating them, and understanding them better as a whole, you also can gain confidence and conviction in the strategies that work best for you and can have peace of mind with your investments. These spreadsheets are definitely feature-packed and will continue to be improved upon with your support and guidance, but here are all the main highlights I've built into it so far. First of all, we'll start with the dashboard, where you'll get a detailed high-level view of your entire portfolio performance at a glance, keep up to date with upcoming ex-dividend dates and incoming dividends, the ability to monitor and clearly identify trends and problem areas quickly, view your progress in monthly dividends and portfolio value projections, get to choose between light and dark modes available with future possible iterations and designs, and also manage up to 2 accounts in one spreadsheet with individual dashboards. Now moving on to portfolio management, this is where you'll have the most detailed view of your holdings, and on here I built in the Neo Exchange stock availability and included automatic updates, added various indicators to help assist with the analysis of current values of each holding, focused on showing you the total return of each holding to provide the most accurate assessment of its overall performance, made the ability to create queues in advance for incoming deposits or dividends and easily see how it will affect the portfolio, then finally created a series of visual charts to easily identify and compare performances and progress. Then as the hub for all dividend payments, here you can input all dividend information for the most accurate projections. There is also built-in automatic conditional formatting that will highlight based on statuses and deadlines. And you can also keep track of when you receive dividends and check them off along the way. Then based on your input, in the dividend calendar, it'll automatically update and highlight the calendar based on the dates provided. And of course, with investing, we all have personal goals set for your own portfolio based on annual dividends, portfolio investment, and portfolio value, while calculating for progression tracking to calculate when the goal will be achieved, and then have automatic updates when goals are achieved and start the next milestone. But we not only have goals, but also have portfolio projections, where you can create long-term portfolio growth projections to keep track of progression towards retirement, and also create short-term goals for portfolio value and see when it will be reached. Then to power all this would be the transactions history section, where it acts as a robust hub for all transactions that make it easier to drill down to find information, analysis, and past performance. There are specific columns for actualized profits and losses from trading, along with individual lot values for performance tracking. And finally, there is also a watch list, where you can easily populate the watch list and filter based on a range of metrics that automatically populates. You'll also be able to compare the dividend returns of each stock or ETF based on a specified investment value. Additionally, it automatically highlights based on ownership within the portfolio. Now before we end the video, there's also a special offer for the first 50 people who are early birds to join and be part of the community and initial users of the spreadsheets. All early birds can get a discounted 1-month trial for just $2 before deciding to move to a paid tier of their choice. And as an added bonus thank you for being part of the initial launch, you can also be upgraded to the next tier above at no extra cost for the lifetime of your subscription once the 1-month trial ends. My goal with these spreadsheets and YouTube channel in general is to make sure I can do everything I can to ensure your success and to help those who are interested in dividend investing to get started. So I want to thank everyone for the support so far as I figure out this YouTube journey, and hope that you continue to find value in these videos. And with that, I'll see you in the next video.